Yeah, I'm gonna kick us off here today. So I'm here with Alex, who I'm a lender. Alex is a realtor, and we are pumped to be here together and to just chat, which is great. So
We've got a couple of topics that we're going to be going through today. Mainly credit. Is it a good system? How does it affect, your real estate purchases? Are there some changes that should be made to it, et cetera, as well as what the market's doing? Because we got to do a monthly market update every month, I guess, just to let you guys know what's going on. But I guess which one should we start with first?
maybe let's get the market done and out the way, and then we can delve into some other topics. So
Let's do it. So I'll kick off the real estate side. So as of right now, average days on market is 44 days. That stayed pretty static, hasn't gone up or down at all. Average list price is $636,000. Average sold price is $627,000, which basically means any home that's on the market right now, they're on average selling for less than what they're listed for, which means you can come in, negotiate for closing cost coverage, just negotiate the price in general. And the number of sales is 3,000 homes, which is pretty average. Approximately 3,000 homes are sold every month, and this is going to be important here in a moment. Okay, let's see. Because the amount of homes on the market is almost 9,000. We are at 8,945 homes. So starting to see an increase, which is honestly expected. Like I've been saying, we're going to see inventory increase. It's just the time of the year. It's not a huge problem at its current state right now until we start getting to the 10,000 home mark. Once we hit like 10,000 or so, maybe push a little past that, that's when we got to start looking at like, okay, there might be a problem in terms of prices coming down, come next year.
can I ask you a quick question on that?
Yeah.
So do you know roughly where we're at, like at this time of year last year? So 2022, around kind of August, September kind of time period.
I can actually check. It might take me a minute, but we were around 7,600, 7,800.
Okay. So we do have more homes on the market this year than.
Yeah. And last year we were like dealing with an inventory issue. So we were actually really low last year. Mm-hmm. This time is about where we should be on average. So we're starting to return to like more of a normal market. If we see like a crazy increase from this point, that's when we got to be a little concerned. Mm-hmm. I'm not concerned at all. This is pretty normal. But like I said, as we get into winter months, it does start slowing down for sellers, which is a good thing for buyers. If you're buying, you don't want to buy it when sellers are super busy because you're not going to get the best deal, right?
Yeah.
So it's actually a pretty good time to start looking between now and January, February-ish. I would start looking like I would really make a decision of purchasing like December. That's a really good time to buy. But yeah.
So on that as well, because I've heard you say this a couple of times, you talk about January, February, is coming off of the tail end of kind of buyer power. Because I know, summer is definitely when it's the seller's game. So between that though, like February to May, is it still kind of shifting more into a seller's market or?
Yeah, February to May, like as spring starts kicking off,
yeah,
that's when we start seeing it pick up.
Okay. Cool.
This year was kind of weird because it didn't stop snowing until like May.
People are still thinking it's winter.
Yeah, so it was still a little slow.
Okay.
But then for whatever reason, like May, June, like May, June, boom, just floodgates opened. Mm-hmm. And speaking of inventory, so remember that 3,000 homes number that were sold this month? That means we have basically 3 months of inventory. So that's really low still. That's still extremely low. 3 months, meaning if no homes were listed between now and 3 months, all the homes on the market would be absorbed, meaning purchased, sold, gone. Okay. 3 months isn't very much. We should, like a healthy amount is like 6 months of inventory. And you're probably curious why I'm saying like if we hit 10,000 homes, we're going to be in trouble. 6 months is like about where you want to be, but it doesn't necessarily mean it's a good thing for the market. Just because 6 months of inventory would mean we have 18,000 homes on the market.
amount of homes.
which is a crap ton. And I don't think that would be very good for the market. So yeah, we're about where we should be right now. We're in a healthy spot.
What do you realistically think that we would get up to over this winter? Do you think we'll stay pretty consistent around the 9,000 mark, or what do you think?
I don't know, because we're starting to see a slowdown of listings just because people have killer interest rates from the last couple of years.
Yeah, exactly.
I don't think it's going to get past 10,000. I don't even think it'll reach 10,000, honestly, but we'll have to find out.
Yeah, it's really interesting because there's a lot of comparisons that get made by a lot of people between right now and like the 2008, 2009 crisis, like the Great Recession, but that the state of the housing market was completely different back then. Like the supply was so high, right? The inventory was crazy high and demand just wasn't there. And that the demand is still there. It's just kind of like a little bit sleepy right now because of interest rates. And yeah, historically we are, even though we're a lot higher, right, with homes on the market, we are still pretty low, like you were talking about, in comparison to other times in history. So
yeah, and I think like even if we do get to like 10, 11,000, I think that's going to happen in like the latter half of the year, like January, February, which will actually line us up really good with springtime.
Yeah, which then kind of the cogs start shifting in the other direction and that number will start coming down.
Yeah, it'll start coming down, but it'll come down in a pretty healthy way.
Okay, cool.
I don't think it's going to be like a crazy feeding frenzy. But yeah, if we hit like 11,000 homes tomorrow, we're going to be in trouble.
Yeah.
But if we hit it in like February, January.
Yeah, it's all kind of like a rate of increase, right? Like how steep is that jump? How steep is that drop?
Exactly.
Yeah, cool.
So that'll line us up really good for spring, but we'll just have to see.
Yeah.
What's going on with rates?
So rates this has been an interesting month because so we started out we were ending last month around kind of that 7 mark, like right about 7 or low 7s for kind of the top level scenario. This month we saw unfortunately it kind of moved very quickly into kind of a negative direction. And the main reason for that is we've spoken a lot about the economy and kind of how, despite kind of what the Fed's been doing, despite kind of really trying to slow down the economy and to bring inflation in line and just to, consumer spending to kind of stifle that a little bit, it hasn't shown a lot of letting up. So jobs have still been strong. Like the economic numbers have still been strong of just, manufacturing reports and all sorts of different things like that. They've all been kind of, for the most part of August, they were coming in very consistently kind of above what was being expected. And so, the narrative had been, that there would be kind of this landing, right, where there would be some kind of a recession, some kind of a drop off, right? And at first the discussion was, it's going to be a pretty crash and burn hard landing because of the rate that the Feds needed to kind of rack up these interest rates. And then the economy just kept pumping, just kept going along. And so the discussion kind of got switched to a more of a soft landing. Like they would get to kind of a recessionary time period, but it wouldn't be quite as crash and burn as what was initially expected. And then after just more and more, the Fed's right at kind of the end of their raising cycle. Like it's not expected that if they raise it anymore. The question is if they will raise it anymore, not when they'll raise it anymore. So most likely the Fed is done kind of pulling that lever to slow down the economy. It's more of like a let's wait and see, unless data says otherwise. But, this is after report after report after report of showing jobs still strong, economy still strong, despite what the Fed has been doing. Kind of the narrative was switched to, okay, is there not going to be kind of a recessionary time period? Is there going to be, like a no landing situation? And so that kind of pushed rates up a little bit higher, as well as, just some demand for bonds kind of slicing down a little bit, both like internationally and domestically. And then coming into this last week of August. So when we're recording this, we're just coming off of the tail end of August, and interestingly enough, the narrative is kind of switching again. So after having so many reports of just strength, we've had quite a few reports that have come out over the last week and a half that are showing some weakness economically, internationally as well as domestically. And then jobs reports that are coming in less than expected. The unemployment rate just hopped up from 3.5 to 3.8, which is still crazy low, but it is the highest. The last time it was at that unemployment rate was back in February of 2022. So it is a change. Still crazy low. Jobs are still strong, but there are some cracks that are beginning to show. So right now we're kind of ending the month right at like lower. So we'd moved up to kind of mid, even like just above mid of sevens. And then this last week and a half has kind of shifted that. There's still, plenty of strong indications from the economy, but, some cracks are changing the momentum shift. So it was very much of kind of an upward trajectory of rates. And then that has kind of curved down a little bit. And so it'll be interesting to see going into September. The Fed will be meeting this month. So we haven't heard from them back since July, as they meet about every 6 weeks. So we'll be hearing from them in about 3 weeks' time. And on the 19th, 20th of September. And it'll be interesting what they have to say, especially if the next inflation report shows is still low, and if jobs reports do show weakness like they've been showing the last little while. So the trajectory could very well continue kind of the change to a downward trend if data continues coming out like that. So that's kind of what we've been doing with interest rates. So,
what do you think is going to happen like during the election?
I don't think there's going to be a too huge factor that's going to go into it one way or the other. There might be some kind of a little bit of a change based on kind of the economic policies of it, of who's kind of more likely to be sitting in the chair next.
Do you think they're going to try to make it like a really good situation for like the whole duration of the election, just to make, whatever party wants to win, try to win?
Well, I'm sure one way or the other, I'm sure that the current president wants to be remembered pretty well. And yeah, if we're going into the election day on the back of a crappy economic situation, it's definitely going to be not to his favor. So I imagine it will affect it somewhat, but it's not like the main players are going to be, what the numbers are showing on it. So, it definitely could have an effect.
What are you seeing for like best, middle, worst case scenario for borrowers right now in terms of like what the rate is? Like they're putting down the minimum. I know there's like different, loan types like FHA and conventional and stuff, but like if they're putting down the minimum of those loan types, what is their rate looking like right now?
Yeah, so going into buying a home, so if you're looking at a conventional loan, you're most likely going to be at a rate of low to mid sevens. If you're looking at a FHA loan, a USDA loan, a VA loan, one of those kinds of loans, then probably like mid to upper sixes, low sevens is most likely. So kind of around kind of upper sixes is definitely possible. Everyone's situation is going to be different depending on credit score, how much you put down, the type of home factors into it, whether it's a house, whether it's a condo. But yeah, that's kind of like broad range. And it again, by the time this video is you're seeing this video, rates are going to be different.
They're going to be totally different.
Yeah, literally, they'll change between a morning and an afternoon. So they do fluctuate so much. So again, this is based September September 1st.
September 1st at 11:19.
Yes,
11:20 might change.
How many seconds? But yeah, so that's kind of what rates have done throughout the course of August, and plenty more changes that can be coming up soon. So,
are refinances looking the same in terms of rates, or are they a little different?
Refinances normally are a little bit better, and it depends whether you're talking about like a straight like streamline refinance where it's just like a rate and term. So that's if you're just changing your current home, or if you're rolling in like a HELOC, like a second mortgage, you can still roll that into, and it's just a straight refi. It's not a cash out. If you're rolling a second mortgage into that, those rates are a little bit better. Cash out mortgages are going to be a little bit higher rate than a purchase or a regular refinance because you're tapping into that equity. It's not quite as there's a little bit there's a little bit more risk involved with that. So that's going to be a little bit higher than a standard conventional loan. But again, if it's a situation where you've got plenty of other debts on your books, you've got plenty of credit cards, you've got plenty of car loans and other things like that, it still could be in your best interest. You could be saving dollar bills per month to either sell and buy and use some of that equity for that, or to do a refinance. It's not going to make sense for everybody and maybe most people, but there are situations where it could be your benefit. If you have a lot of other debts that are weighing down your money each month, the interest rate switch is not going to be a pretty change, but the dollar bills that you still have in your pocket could be. So that's refinances definitely are a lot less than they were back in like 2020, 2021 for obvious reasons. But there definitely are situations where they can be helpful. Yeah.
And I guess historically, I don't know even if that's even the right word, but like how much lower is like a straight refinance interest rate versus like a normal purchase interest rate?
Man, I'm like trying to think off the top. It's not much. I would probably say around like an eighth. There's not like a big change in interest rate with the rate and term. It's going to be a little bit less.
Yeah.
But yeah, and then a cash out, you're probably looking. I don't know. It's gonna depend, but probably it's gonna depend on your loan to value. It's gonna depend on a lot of different things, but maybe like a 0.25% higher or something like that. So
yeah, that makes sense. Okay. And then let's kind of transition a little bit.
Yeah.
How does credit play into what interest rate you get?
Yeah. So it's huge. Like it's a big spectrum of there was a lot of kind of mistaken assumptions made earlier this year, as there was a couple of different changes with the ways that mortgage interest rates were done. They're called LLPAs, and basically that's how interest rates are tied to different credit scores, different down payments, and different things like that. And yeah, there was some changes, and it was there was some people thinking that the switch had been made, so now people with lower credit scores had better interest rates than people with higher credit scores. That's not the case, but things were changed a little bit. So if you have a lower credit score than someone that has a higher credit score, you're always going to be paying a higher rate. And they do it in kind of like increments. So generally it's like a 20-point kind of block or somewhere a little bit bigger. So like a 700 to 720 or 719 credit score is going to have the exact same, that's the exact same interest rate if everything else is the same. And then it goes up and up and up. So now it's like the top end is like up to around like a 780. So it does really affect it. And so it is really, really important that...
How much would you say? I mean, I know it's kind of hard to say, but like from a 700 credit score to a 740 credit score, what's the difference?
And it does very much depend on your loan type. Conventional loans, they are mean when it comes to credit scores. So they like... could be an 1/8 to a 1/4 point. So it does. Okay. And like, if you're looking at like a 700 credit score compared to like 780, or like 760, it's going to be a lot higher. So like, if you're looking at difference between credit score of, and even in the 600s, low 600s, because conventional can go all the way down to a 620. But when you're down at a 620 compared to like 780, it could be like a point plus. So it does change it a lot. And so making sure you have kind of a good credit score as you're preparing to buy a house does really affect your monthly payment by a lot. There are loan types like FHA loans, which are a lot more, if you're kind of in that kind of mid 600 range or high 600 range, or, you can go with a FHA all the way down to, within even mid 500s, but there's a lot, once you're below 580, then you have to start putting 10% down on an FHA loan. But anything above a 580 to a, 700 and even low 700s, an FHA loan is you're going to be hit a lot less for your credit score than a conventional loan.
What's the lowest credit score you've ever got someone into a home with?
I think it was about 580. I think it was about 580. I haven't, there are options, and I've worked with borrowers that have been in a situation where they are below 580, like where people are like mid 500s, which it's possible to do. But oftentimes if you are in that kind of credit rating, generally you don't have a ton of cash to be able to put down on a home. And if you are below that, as I said, you need 10% down. So a lot of times those don't kind of work hand in hand. And so normally what I'll do is run through and give people kind of a plan of helping to increase and build up their credit. Because it's going to, first of all, it's, just establishing good practices and different things like that, and getting really good way of preparing for buying a house. But it's not a foolproof system, like the way credit's calculated. It's funny, like even before I was in mortgages, like back when I was in college, I worked for a credit union for a while, and and I did some like consumer loans during that time. So I did like some car loans and different things like that. And our credit union's policy was like, if it's their primary car, it's the one that they're going to use to get to work. Like they didn't really care what I did loans. I did a loan for someone that had like a 470 credit score or something. I did quite a few loans for people that like had credit scores in the 500s and 600. And when I left that credit union, I had a perfect history where not a single person I'd ever helped, and I'd helped like hundreds, had ever
defaulted.
Yeah. So
that's crazy.
So it's like the credit score is important in some ways, but in no way does it perfectly predict someone that's going to pay you back. There's a lot of other factors that go into it. So
yeah. That's crazy. That's actually surprising.
Yeah, it's nuts. So
let's switch gears a little bit. So I guess let's go into a couple of things.
Yeah.
What can a potential buyer do right now if they've never established credit, or they were too late to it, or they have bad credit? Let's go through some things that they can do to get ready to purchase a home within the next 6 to 12 months.
Yeah.
Maybe even sooner. I don't know. And then let's also go through if we even think credit's a good system.
Yeah, for sure.
So what are some things people can do to help their credit?
Yeah, for sure. So it's really important, first of all, to know kind of how credit's built and how it's made up. So they kind of the biggest chunk of it, about 35% of it, has to do with your payments. So are your payments being made on time? Basically is a huge portion of it. So if there's different things like collections, just past due bills, that goes kind of into that bracket. And then the other bracket is the other biggest bracket boils down to your credit card usage ratio. So what percentage of your balances are you using? So if you have like $1,000 credit card limit, right, of all of your credit cards, and you have a $500 balance that's getting reported to the credit bureau each month, you're using 50% of your limits, and that's going to hit you pretty hard. So those two are the biggest, because that accounts for 65%. Other things, like how long have you had credit? How many inquiries do you have on your credit report? Lots of different things like that. So those are important, but those two big factors are going to help you the most is getting those right. So if you don't have any credit card ever established, if you don't have any credit ever established, you don't have a credit score, first and foremost, I would say is go open up a credit card. Because having, you don't get those points for that 30% if you don't have a credit line. So you need to have a credit line open. So if you have closed out your credit cards or you've never opened a credit card, you should have a credit card open. Whether you're using it consistently or not, doesn't matter. It needs to be open and just pay it off. Don't like rack up. Don't spend money that you don't have in your checking account or savings account. Don't do it. But have a credit card that you can, so you're getting those points.
I've heard some people say, like, to grow your credit score faster, like, don't pay it off like as soon as it's due, wait a little bit and then pay it off. Don't do that either. Pay it off immediately. It doesn't work that way.
No, and it's
there's not like a cheat code.
Yeah, and I'm not like trying to brag or anything. I have only used a credit card rather than a debit card for the past decade, and I have never paid a cent in interest because if you pay it off so the way it starts accruing interest, at the end, let's say your payment due date is the statement date is the end of the month. So let's say right now, August 31st was the end of the month, and let's say your statement has $500 that you need to pay off. So, and then your payment date, let's say your due date is on the 25th of the month. So if you pay off whatever balance was on your card on the 31st by the 25th, so after the 25th, right, you can either make your minimum payment, but if there's anything, if whatever was on this statement is still on your card, that's when you start accruing interest. So as long as you've paid off what was on your statement balance, and preferably just pay it all off, but as long as you've paid off what was accrued on the month before, you will never pay interest. And you will never get yourself in this huge hole. But first and foremost, just don't spend money you don't have. But that's the biggest thing. Just go open up a credit card. And don't go open up 12 credit cards. Then you get hit with your average age goes down of your credit. You have a ton of inquiries on your credit. You have to manage these 12 different credit cards from...
Absolute nightmare.
It's terrible. But so... That's the biggest thing. That's keep that ratio low, have open trade lines, keep it low, and then just make sure that all of your payments are being made on time every single month. And basically it's as it goes further in the past. So if you have a collection that's 1 month old compared to 3 years old, they're going to affect your credit way different. So just make sure your current payments are being made on time and let stuff go further in the past.
Yeah, I think a lot of people are scared of debt, credit, whatever. Dave Ramsey's a great guy. I could shit on him all day. I'm not a financial advisor, but there's a lot of crap he says that I think is just stupid. You're not going to be able to save up enough money, most likely, to buy a house with cash. That's kind of a thing of the past. Houses aren't 20 grand anymore, unfortunately. But yeah, don't save up. Honestly, it's just not even smart to buy a house with cash. There's a lot better things to do with your money. But anyways.
He teaches a lot of awesome principles of like helping people that are in kind of a rut to get out of that rut. So it's great. I respect him and everything, but in like there's a couple, but specifically to credit scores, that he says it is a measure of how much you love debt. Like that's what he calls it. And he says it's not important to have a credit score. And I think he said like he doesn't have a credit score and he's proud of that fact. But again,
I think that's a lie.
Yeah.
There's no way he doesn't.
If you haven't had a loan open for like a loan or a line of credit or anything open for like years and there's no activity, actually your credit gets junked in. It fades away. So, but most people out there don't have Dave Ramsey's millions. Most people can't pay straight cash for their car that they need to get to work. And most people can't pay straight cash for their mortgage. And he also says, don't ever get a 30-year mortgage, get a 15-year mortgage. Well, most people can't afford a 15-year mortgage. And especially with where homes are at right now, just a lot of the things aren't realistic.
Yeah. Especially if you're an investor, it's actually kind of dumb to get a 15-year mortgage.
Yeah.
Like we can get into this all day, but there's a lot of crap that he says, which he's a good dude. He helps a lot of people, but a lot of the stuff he says is just isn't the best advice right now. That being said, if you use a credit card wisely, it can actually be better than buying cash. There's so many benefits of credit cards that a lot of people don't talk about because they're scared of debt or whatever. And in fact, not only have I not paid interest on any of my credit cards, and you haven't either, but I'm sure we can both agree we've gotten actually a crap ton of points, and actually our credit card pays us money to use it.
Yeah.
So we've actually profited by using our credit card.
Yeah.
And if you don't have a credit card, or if you've never had credit established, not a financial advisor or whatever, my first credit card was the Discover It card. Honestly, I still use it. It's a pretty good card. Once you establish your credit, usually it takes about 6 months. The next one I got was Amazon Prime card. I use that thing every day. I get 5% back on anything Amazon, and that's pretty dope. But anyways, that's neither here nor there.
Yeah, there's a lot of benefit. You can use so many Sky Miles instead of it's so much better than paying for flights and different things like that. It saves you hundreds and hundreds and hundreds of dollars, all for using this card instead of this card.
Spending money you would have spent otherwise.
Yeah, as long as you're spending it, as long as you have the money to pay it off.
Mm-hmm.
But yeah, there is, and it's just, the difference between, for instance, if let's say you're in that kind of Dave Ramsey boat where he's saying you don't need to have a credit, don't have a credit score, it's not going to help you, right? As opposed to someone that has phenomenal credit is, if you're trying to buy a house, right? And if you don't have an established credit score, there are loan programs that you can do if you don't have a FICO score, but the interest rate is going to be a heck of a lot higher. Mm-hmm. And you're probably going to need to put more down and all sorts of different things. And so it's just going to save you a lot of money in the future to make sure that your credit score is good and it's up to snuff. And you honestly don't need to be making tons of money to have a really good credit score. I'm not trying to brag or anything like that, but I had a really good credit score all throughout college when I didn't have a ton of money, but because I had a credit card that was open, that I used, that I paid off consistently, never went past due. And so you can have a phenomenal credit score and you don't need to be making hundreds of thousands of dollars to do it. But it's going to save you thousands and thousands of dollars by having that score. And it's by, simple steps. So,
yeah. And anyways, topic for another day, but let's get into this a little bit. I know we're running out of time, but what do you think about the whole credit system?
So it's important, as I said before, the whole thing it's trying to establish is, are you the kind of person that's gonna pay me back, right? Like a bank, if you put it in a really kind way, it's like an establishment of trust, right? If we give you this money, how much trust do we have that you're going to pay me back? And then they give you a number that is slapped on your name. But again, that is not a perfect system of deciding who's going to pay you back, because as I was just talking about a while earlier, I had loans, consumer loans, and all sorts of different things, and home loans for people that are in the 500s, people that even went down to the 400s, that always paid back, that always made their monthly payment on time and everything like that. Even though their score said that
they're not going to pay back.
Yeah, I'm not. Yeah, this is sunk. Your money's gone. And so there's so much missing from the narrative of just a score. But they have to, you know, so it's I by no means think it's a perfect system. What do you think?
I don't think it's perfect, and I don't think it covers everything that could happen and will happen or whatever. But I do think it's almost as good as it can get, minus a couple things. I mean, I think there should be other things, like for people who just don't have credit score, there's no way to tell if they're going to pay you back.
Yeah.
Because they don't have a credit score. But I do think there should be ways where you can kind of qualify them and see, okay, well, this guy, he doesn't have a credit score, but he's got like $300,000 in the bank and he's buying a $500,000 house. He's pretty good with money. He just doesn't use debt at all. So I think like, okay, with that guy, we could probably give him a pretty decent rate or whatever.
Yeah, some kind of concession when it's, because it is, you know, someone that is a bright-eyed 18-year-old who has never had any kind of loan, is in the same kind of non-FICO kind of bracket as someone who like just pays cash for everything and never has done credit, where they both don't have a FICO. So yeah, that's a good point.
Yeah, I think like for something like that, there should be something there. I think it's honestly, I think it's better than China's system. Personally,
I actually don't know what is China's system.
They have like a social credit score system.
Oh,
it's like weird.
I
it's
think
like
I've heard about that. Yeah.
Yeah. It's like, oh, if you talk bad about the government, your social credit goes down. If you talk good about the government, your social credit goes up. It's like, it's weird. I'm going to be honest. I don't really know. I'm just talking crap on China, but sorry. But, I don't know if it directly correlates to like their finances. Like, I don't know if it means you can go in and get a loan. I don't know exactly how those correlate. I just know that their social credit system is a little weird, but yeah.
Yeah, that would be, if that existed in the US, that would be crazy. Like every time there was a kind of a Democratic presidency established, like all the Republican states' social credit scores would go down. And every time there's a Republican president, all the Democratic ones would go down. So you'd just be up and down every 4 years. But yeah, no, that's crazy.
Do you know what kind of do you have a better system in mind?
Yeah, let me redo the whole like right here at this table. I don't, but I think there should be. I think, you know, there are loan options that exist for things like that. I think there should be a bigger, I feel like there should be more of a concession in interest rates. Like interest rates should not be hit as hard for a difference in credit score with other factors. So like if you do have, you know, if you do have like hundreds of $1,000s in the bank, right? You're going to be someone with a 660 credit score that is living paycheck to paycheck, and someone that has a 660 credit score that has $1 million in the bank. That is not the same risk profile. But according to the credit score, it is, right? But so there should be, you know, approval wise, getting the loan approved and done and dusted, one is going to be easier than the other, right? But interest rate wise, they're not, right? They're not going to be, you know, assets. The amount of down payment, yes, affects it, but the type of house, yes, affects it, but the like amount of assets doesn't affect the interest rate. And so I think there should be some kind of tailoring a little bit more, I would think, to be able to more adequately address risk. I do feel like, similar to what you said, I do feel like on the whole it does a pretty good job, but I do feel like it does have some shortcomings for sure. So and then as well, you have people. For instance, there's people that I've helped that have, you know, a mid 600, low 600 credit score, that is not making a ton a ton of money, but they do, you know, keep up most of their debts, and then, you know, other borrower that is in like the mid 700 credit score has phenomenal income, but they have really high debts. And like, I've seen situations where the one that's getting paid a lot more and the one that has the higher credit score is much closer to bankruptcy than the other. And so,
wow,
it doesn't, it doesn't always
directly correlate.
Yeah, it doesn't always directly correlate. I would say for the most part, it does a lot more than it doesn't, but it's definitely not a perfect system.
Yeah.
So.
Would you agree that like an 18 to 20-year-old is an adult?
Yeah, they're pretty fresh, but
they're fresh. But
where's that going?
Yeah, you'll see. So
Okay.
I saw this video.
Okay.
I'm gonna pull it up actually, but on when I edit this, but it was I think it was a 19-year-old girlfriend and a 19-year-old boyfriend or 20-year-old boyfriend or something like that. You know what a Hellcat is?
Yeah.
Yeah. So they went in and financed a Hellcat together. Boyfriend and girlfriend, not married or anything. Probably barely started dating. That car loan, the term of the loan is probably going to last longer than the relationship, to be honest. But anyways, they went, I think the car's like $80,000.
That's crazy.
They went in and financed it. Super predatory car salesman.
Yeah,
Screw that guy.
Yeah.
But do you think that kind of thing should be allowed? Do you think there should be limits to what you can? I mean, granted, they're adults.
Yeah, because I mean, prior to 18, my understanding is legally you know, a contract can be considered voidable. So you can't. But like once you pass that 18 mark, then it's, you know, once you sign a contract, it's. I feel like there should be. There should be some more like anti-predatory lending. Like, for instance, there have been a lot of changes that happened with the Dodd-Frank Act, and that was like a big, huge, massive piece of legislation that came out after the Great Recession, just because of a lot of there's quite a bit of like sketchy lending that was going on before, where you'd just be like, yeah, I make $1 million, and they're like, okay, and then give you whatever you want. But I feel like there are still more like you're setting someone up for failure when it's that situation where you're really putting kind of a huge weight around someone's neck. And I think it's really important for lenders, for real estate agents. You know, we both agree on this, that everybody that we're helping, that we're having their best interest in mind. And I think sometimes we have the responsibility to push back a little bit when someone might be pushing themselves or stretching themselves a little bit too thin. Ultimately, it is their decision. You know, they are an adult; they get to choose what they want to do. But I do think there is a responsibility, like for that guy, to be like, all right,
this is a really bad idea.
This is going to be really expensive. Are you sure that this is a step that you want to make, rather than just be like, yep, let's go. So, I don't know about that. Especially when you're in that age, like you make decisions in that age that, you know, prior to 20 and then early 20s, you know, if you leverage yourself in a ton of debt right from the get-go, that's going to be, depending on the type of debt, right? You know, an investment property is very different than a Hellcat. But it's going to be a weight around you for a long time, and you just want to make sure you're starting off your adult years in a good way. So
yeah, but yeah, looks like we're running out of time. I mean, I could personally go on all day, whether or not even college should be a thing. Like, anyways,
yeah, I think for sure. I think I would really like the school systems to do a better job of this is something I've always felt of the school systems, you know, especially you know, in high school. I know there are some classes you can take and different things like that, but I think they should do a really, you know, make it a really main event of being a high school student, that you are teaching financial literacy and setting these kids up for success, so that when they are out in the world, are out going and spending their money, setting up credit, you know, you can trash your credit score as an 18-year-old and spend years trying to pull it back, or just get yourself in a ton of credit cards. So I think it is. I really wish that that's something I would really like to see, is make a bigger emphasis on that, because that would help a lot of people. So
yeah, I agree. We can go on all day about this, but unfortunately we are out of time.
Yeah. Until the next time.
We appreciate you guys watching. Luckily, Oscar's going to be here for a couple more episodes in person, so we're not going to have to deal with a Zoom or whatever we were using, Riverside, whatever. But yeah, luckily he's going to be here, and we appreciate your guys' time. As always, thank you for watching. Peace out.